If you died tomorrow, would your family be okay financially? Would the mortgage or rent be paid next month or even next year? Would your kids be looked after not only emotionally, but financially? Or would your partner be forced back to work immediately just to keep things going? Most people avoid even thinking about death, and even fewer want to talk about life insurance because, let's be honest, it's full of jargon and the industry has a special knack of intentionally making it more confusing than it needs to be. And then there's the hard selling on top of that. Hi, I'm KVE&x. I'm a financial planner based in Ireland, and I'm not tied to any life company. I work for my clients, not any provider. And what I see again and again is this: people either have way too much cover or not nearly enough, and they have no idea which one it is. In this video, I'm going to break down life insurance in plain English. We're going to look at the myths, the different types of cover, how much cover you actually need, and most importantly, what to avoid. This video won't win me many friends with the life companies, but my goal is to educate you, not serve them. Let's talk about some of the most common myths around life insurance, because these are the things that stop most people from getting the cover that they actually need. Myth number one is only the breadwinner needs life cover. This one comes up all the time, and it couldn't be further from the truth. If your partner is a stay-at-home parent or carer, they may not bring salary into the household, but they do provide real financial value every single day, whether that is childcare, cleaning, school runs, meal prep, managing the household. If something happened to them, you'd either have to take a step back from your job and fulfill the role, or pay someone else to take it over. According to research from Royal London, Ireland, estimated annual value of a stay-at-home parent is €57,140. That's what it will cost to pay for the services that the stay-at-home parent or parent provides. And yet, most families never think to even insure that risk. So even if one of you doesn't earn an income, it still makes financial sense to have some cover in place. Myth number two is I rent, so therefore I don't need life insurance. This is a big one, especially in Ireland today. If your family depends on your income to pay rent or bills, then you still need protection, even if you don't own your own home. Myth number three, my job already gives me cover. Now, some employers do offer death and service benefits. It's usually 3 to 4 times your annual salary, but that is rarely enough. And if you leave the job, the cover goes with it immediately. Myth number four is I'm too young to worry about this. Actually, in your 20s and 30s are the best time to buy life cover. You're healthier, therefore the premiums will be lower, and you can lock in a better rate for 20 to 30 years. The truth is, life insurance isn't just for parents or homeowners, it is for anyone whose absence will create a financial gap. So now that we've cleared up some of the myths, let's look at the main type of life cover that's available in Ireland. These are the 3 core types you're likely to come across. And the first is term life insurance. This is the most straightforward and the most cost-effective. You take out a policy for a set number of years, let's say it's 20 or 30 years. If you die during that time, the policy pays out a lump sum to your beneficiaries. If you don't, the policy ends and there is no payout. That might sound like a bad deal, but remember, the goal isn't to cash in, the goal is to protect your family if the worst should happen. It's simple, there is no investment element, less complicated fee structures, it's just affordable, straightforward protection. For most families, this is the right starting point. Now, to give you an idea of price, a 35-year-old non-smoker may pay €20 a month for cover of €500,000 in term cover, but over €150 a month for the same cover if it was a whole of life policy. You can add options onto your policy, such as a convertible term cover. This lets you extend or convert the policy later without another medical exam. This is very useful if you have any health changes over the period of time. Another option is indexation, which increases your cover annually to keep up with the rate of inflation, though your premium will increase too over the same period. And thirdly, if you're in a couple, ask about joint or dual life cover. Joint life pays out once on the first death, whereas dual life pays out twice, one for each person. The cost difference is often small, but the impact can be huge. The second is whole of life insurance. This one is often marketed as guaranteed payout, which is true, but it comes with a cost. The premiums are significantly higher, often up to 5 to 10 times more expensive than term insurance. And many of these policies include an investment component. But here's what most people don't realize. The cash value inside the policy, it grows really slowly and often comes with very high fees. And when you die, your family only gets the death benefit, not the savings that you've built up inside the policy. In most cases, you're better off buying term insurance and investing separately where you have greater control. That said, whole-of-life policies can work really well for estate planning, especially to cover inheritance tax liabilities when passing on a property or a significant asset. But if you're not on that boat, term cover is usually the smarter option. The third is mortgage protection. This is a specific type of insurance required by most lenders. It is designed to clear your mortgage balance if you die before the loan is repaid. The cover amount decreases over time just as your mortgage amortizes. And if you die, the payout goes directly to the lender, not to your family. So it won't help with your household bills, it won't replace lost income, and it won't support your kids. Mortgage protection is important. Well, it's actually a legal requirement, but it is not a substitute for real-life cover. Another option worth knowing, especially if you're self-employed or a company director, is pension term assurance. It's a type of term life insurance that qualifies for full income tax relief, just like a pension contribution. So if you're in the 40% income tax bracket, a €100 policy may effectively cost you 60. It's only available if you meet certain revenue rules, and the policy must end before age 75. But for the right person, it's a very tax-efficient way to get essential cover. Now, two other products that are worth mentioning, just because people often confuse them with life insurance, are specified illness cover, which pays a lump sum if you're diagnosed with a serious illness. For example, whether it's a stroke or a specific type of cancer. And then the other is income protection, which replaces part of your salary if you're too ill or injured to work. Both are useful, and we'll look at them in more detail in a minute, but they're not life insurance. Life cover is about one thing: making sure your family is okay financially if you are not here to earn. So if you're wondering where you stand with all this, let's have a quick chat. I offer a free, no obligation call for people who want real clarity, not just another product pitch. We'll look at what cover you already have, what you may be missing, and how it fits into your overall financial picture. Click the link in the description below. It's simple, pressure-free, and built around you. You've seen the types, but how do you choose which actually is right for you? Here's how to think about it. Start with your goal. If your main concern is making sure your partner or kids are financially okay if something were to happen to you, then term life insurance is usually the simplest and most cost-effective way to do that. It gives you solid cover for the years when your income is essential. It's perfect if you're in your 20s, 30s, or 40s, raising a family, paying a mortgage, or just building towards retirement. If you want cover that will definitely pay out in some format, no matter when you die, then that's where whole of life insurance comes in. But the price difference is massive, so unless you have a specific estate planning reason, like covering inheritance tax, it's usually not necessary for most people. Mortgage protection is a legal requirement. You have to have it if you have a home loan. But again, that's just about protecting the bank's interest, not your family's lifestyle. So what product is best for you? It's whatever gives you peace of mind that your loved ones won't suffer financially if something were to happen to you. And if you're not sure, that's normal. A quick review with someone independent can help you get clear, fast insight. So how much life cover do you actually need? This is where most people either massively underdo it or overspend on a figure they were never comfortable with in the first place. So here's how to work it out properly. Step number 1, look at your household expenses. What does it take to keep everything running each month? So that is the rent, any loans with no mortgage protection, the groceries, education bills, childcare, etc. Let's say your total monthly spending is €3,500 per month. That's €42,000 per year. Step number 2 is to subtract any income that would continue if you died. Let's say it's the widow's pension. Then, for example, if your spouse may continue to work part-time, or if you have rental income from a property. Let's say your partner earns €800 per month, and the rental income brings in €1,000 net. That is a total of €1,800. So the 3,500 minus 1,800. That gives a shortfall of €1,700 per month, or $20,400 a year. Step number 3 is to deduct any existing cover. So for example, let's say your employer provides a death and service benefit. We will look at this in more detail in the next section. Step number 4 is to multiply the shortfall by the number of years family would need support. In most cases, life insurance is designed to last until retirement age, because once you retire, you're no longer relying on employment income, and that's when personal and state pensions are expected to kick in. So if you're 40 now and want cover until you're 65, that is a 25-year window. So let's say it's 20,400 multiplied by 25, it's 510,000 euro. That's your target cover amount based on your own specific numbers. Of course, you can use basic rules of thumb too. In your 30s, it's 20 times your income. In your 40s, it's 15 times your income. In your 50s, it's 10 times your income. But nothing beats a personalized approach. And here's the final step. Make sure the premium is affordable. There is no value in aiming for a bigger number if the monthly cost puts pressure on your budget. The best life insurance is the one that you can afford to keep, not just start and cancel a year later. Before you take out any new policy, it's important to check what cover you already have in place, because you might be more protected than you actually realize. Start with mortgage protection. If you own your own home and have a mortgage, chances are you already have this cover in place because it is a legal requirement. The next is to check your workplace benefits. Some employers offer what's called death and service cover. It's usually 3 to 4 times your annual salary if you pass away. Say you earn 50,000 euros per year, that could be a cover of 150 to 200,000 euro. Helpful, yes, but it is rarely enough on its own. And if it's tied to your job, and whether you move or go self-employed, that cover likely just disappears. Also look at pension or any PRSA documents. Some pension plans, especially older ones, will include a death benefit. It could be a lump sum or even a refund for contributions. These are often very small, and many people don't even realize that they're there. Here is why this matters. Before you go buying a big new policy, you want to understand the full picture. What cover already is in place, what's guaranteed, and what's conditional, and how long each piece lasts. When you figure this out, it'll give you the most important number of all, a gap, because once you know the gap, you can cover it effectively without overpaying or leaving your family exposed. Now let's talk about what to watch out for, because this is where a lot of people get tripped up. First, avoid paying for cover you don't need. Some policies will bundle in extras like specified illness cover, indexation, or conversion options. And while these can be useful, they often double or treble the premium. So you should ask yourself, do I actually need this feature? Or am I being sold an expensive version of a very basic product? Second, understand how your policy pays out. Some policies pay a lump sum, others pay a monthly income over time. A lump sum gives your family flexibility, but it also can be overwhelming to manage. A monthly income could be simpler, but in this instance, you're giving up some control. Know what you're getting and why. Third, watch for increasing premiums. Some policies start low, but they increase every single year. Others are fixed for the full term. Fixed premiums make budgeting easier, but it may be slightly higher at the beginning. Make sure the cost is affordable now and in 10 years' time. Fourth, know the tax rules. For personal life cover, there is no tax relief on premiums. But if you qualify for pension term assurance, you can get full income tax relief up to 40%, just like a pension contribution. Remember, there are revenue limits. The policy must end before age 75, and you need to have relevant earnings or self-employed income to qualify. For company directors, a corporate executive term policy may allow the business to pay with premiums treated as a business expense. Speak to your accountant or advisor, because the tax treatment depends on how your policy is actually set up at the beginning. Fifth, ask who's actually selling it to you. Life insurance is often sold by brokers or tied agents. Some are independent, others are tied to one specific provider. Ask the question, can they compare across the market, or are they incentivized to push one product to you? It comes at a big difference to both cost and quality. And here's something most people don't know. Every life insurance policy in Ireland comes with a 30-day cooling off period. That means that you could cancel for any reason within 30 days and get a full refund. So if you sign up and later feel that it's not the right fit, you're not locked in. Use that time to double check the fine print. Life insurance isn't exciting. It's not fun to think about or talk about, but it is one of the most important financial decisions that you can make. It's not about fear, it's about clarity. It's about peace of mind for the people who matter most. So here's a challenge for you. I want you to take 10 minutes to go through 4 steps we just discussed. Identify your gap. That's the real cost of replacing you. If you're already covered, great. If not, or you're unsure, reach out. I can help you figure out whether you're over or underinsured, or simply missing a few key parts on your overall financial picture. I work with people who want to engineer their wealth in a way that gives them freedom, not just security. And life cover is just one small part of that entire journey. If you found this video helpful, the next video is a must watch. It answers a question most people don't even ask until it's too late. How much will my pension actually pay me in retirement? We break down real-world pension pot sizes, 250,000, 500,000 and €1 million. And we look at what annual income these pension pots would provide. Now remember, clarity precedes confidence, and I'm here to help you get clarity on your complete financial picture, whether it's retirement, insurance, investing, cash flow, or taxes and legacy planning. Thank you for watching.